So hi there folks, I wanted to touch base and give a little bit of an update on what we're doing with respect to energy inside of our risk parity portfolios for our clients. This is probably one of the hottest topics obviously in the last few weeks, where energy prices caused by the feud with Saudi Arabia and Russia have just been decimated. So what we're going to shed some light on today is a little bit of a different angle, which is probably going to be surprising to most people, on how you can actually take advantage of this environment and move forward with some profit and participating fully in the recovery of commodity prices. So the most important thing to note when it comes to energy is that we are not using less energy long-term under normal circumstances as a globe anytime soon. Yes, there's movements to clean energy. Yes, there's movements to environmental advancements and so on. But for the most part, up until the coronavirus pandemic, we continue to use more and more energy globally, which means that there is going to be increased demand at some point in the future. And so what we need to do is prepare our portfolios properly so that we can take advantage of that upside. Now, what's unique is when we got to the low point of energy prices on March 18th, it was really clear that the movement towards commodities was going to be positive, because everything was just, the baby was getting thrown out with the bathwater. And so what ended up happening was we moved our portfolios to take advantage more on the larger names such as Canadian Natural Resources, Suncor, Meg Energy, Cenovus, etc. And as we did that, we started to see that flight to quality, where now we've seen, since that March 18th low, almost a 70% increase in some of those securities, and sometimes more, which means that the price metrics or the pricing of those securities is not really going to be that favorable, especially when you consider in the same time that the fundamentals for oil has actually deteriorated even worse. And it's going to be quite choppy and quite messy as we go through on this. So what's interesting is, rather than stay long and deal with that volatility, what we're going to do is start shifting towards natural gas. And the reason for this is twofold. One is, when drilling activity slows and there's less activity just globally just because of the low commodity price, that also bodes well for natural gas supply. And the reason why is there's less gas that comes out of the drilling. And so when there's less gas coming out of the drilling, it's going to strengthen the long-term fundamentals for that commodity. Second is, even though we've seen a 30% increase in the spot price for natural gas in late 2021, go up almost 30%, most of the industry, I would say 80–90% of the names in natural gas, have so much debt on their balance sheet that normally when they would ramp up production in these circumstances, they actually are going to be taking that profit and they're going to be putting it towards paying off debt. Not to mention that there's only so many large liquid names in the space which are going to attract institutional investors. Those are the ones that we're going to pay close attention to. Those names include like ARC Resources, Tourmaline, Prairie Sky, although not a direct relationship only with natural gas, but they're going to have some profit on their natural gas division. And then a cool couple of other unique plays in the space is 𝘄𝑄𝑄𝑄, which is actually a US name, and then also some smaller names such as Headwater. Headwater is a unique opportunity where it's been just kind of restructured, and the management team from Raging River Exploration, which was an amazing management team and completely turned around, or is in there to completely turn around this company, they're sitting on over $115 million in cash. So what they're going to be able to do is take advantage. While others are sellers, they're going to be buyers of amazing assets. And the word of the street is that they're actually getting pretty much their pick of any deal because of the strength of their position. So the biggest thing is, you want to make sure that when you're dealing with commodity prices that are going to fluctuate like they have over the last several weeks, both negatively and positively, is you have to make sure that you're actively trading in these environments. And that is done on two different ways. Number one, you have to pick the subsectors that are going to benefit as we move out of these environments. And that is why we're moving towards natural gas and less away from oil. Now, when oil prices, again, perhaps tank, and to match fundamentals, or the prices of those strong securities like Cenovus, Suncor, and Canadian Natural Resources drop again to favorable levels, we'll certainly move and shift into that sector. But for the time being, you have to make sure that you're with the sectors that are going to take full advantage of this. And then number one is, once you've picked the sector, you have to make sure that you're key on what actual underlying companies are going to be really strong performers through this environment. It's going to be unique. There's going to be very, very low prices. There's going to be lack of cash and institutional money flowing into the space. There's going to be very low capital market activity. So the strong management teams that are going to have strong balance sheets and lower debt are going to be able to maintain positive performance through this environment. Names similar like Gibson Energy, who is absolutely slaying it through this environment because they're able to trade and market the securities because of this choppy oil environment. Second would be on Kierra. They're actually crushing it on marketing right now. And although, yes, some of their shut-ins and some of the oil production is going to hurt them, they're going to take a lot of upside coming forward through this natural gas play. So those are examples of how the portfolio is going to shift. It's not a set it and forget it. You have to be nimble when you're dealing with these types of securities in this space. So hopefully that gives you a little bit of a kind of an insight on what we're doing inside the portfolio combined with the managers. And really what we're doing is we're trying to make sure that the capital is put to best use in this sector so that we can take full advantage of the recovery. So till next time, folks, stay safe, and hope everyone's doing well at home and adapting to this new form of life. But we'll be back with you guys soon for more updates. If you have any questions, please feel free to leave a comment in the section below, or reach out to us directly, and we'll be happy to interact and answer any questions that you have. So we'll take care.